going to keeping rising. So I think they talk about the bond markets. So the yield rise quickly in bond market, and rising yield have direct inverse impact on bond return. So you know yield and return is a inverse relation. So your other risks include inflation, and this inflation risk as well. Interest rate is keeping higher. After obtaining advice from David regarding the issues of bond market, Max and Jane consider the risk issue with the bond market as well as investment strategy select for bond portfolio investment. This question is more theory. Sometimes case study I will ask you to do computation. Can be calculation, can be theory as well. Sometimes theory also depend. If calculation even don't look like easy, but some certain students careless calculate, everything will wrong. So here I give two investment factors. When they consider to invest in bond, two risks, what kind of risk they were exposed. If they facing inflation, interest rate are keeping high, and give two long-term strategy to Max and Jane for their bond portfolio investment. So this is more focused on bond. Okay, how to do it? What is the investment factor you need to consider? If I say I give you two, ask you to give me two, you give two. Don't give me 3 and 4. Right? 2 and also go for detail. So this particular answer you should something like this one. So I give this one. Example 1 question 4 mark. You should write something like this. 2 mark, 2 mark. Example this one either two factors. Maybe here I give you 4 factors, right? So you can answer any 2 factors. Bigger. Or your other lecturer better short answer give you to take photo like this.
Yes. Yes.
Yes, man. No upload lah, please lah. We don't want to leave any black and white for you. I have to juggle my job, you know. Cannot be. I just show you this answer, you can take. You cannot take, up to you. So basically, you can look like, example, the 2 factors you want to consider, you have to consider what? Expected return and risk capacity. Like example, you know, they invest on bond, they need to invest for 10 years. When you answer case study, you must put some certain scenario for the case. Example, they rely income for investment for day-to-day need. They look for capital appreciation. They want their fund invest in at least 10 years. They look for bond portfolio can be maximize their return a longer term basic based on capital appreciation and current income. So basically, you look at the expected return and risk and maturity date investment horizon. So example, you have to consider what actually the risk issue, expected return and risk capacity, maturity date investment, and debt allocation for bond issuer. The bond issuer is who? The quality of the issuer, right? And whether the bond is secure or unsecure. This one is a characteristic of bond. How long the bond matured? I think you prefer long-term or short-term bond. Short-term bond, right? High coupon rate. And then quality of issuer. Alright? Expected return and risk capacity, maturity date, investment horizon, debt obligation, bond issuer. Whether bond is secure or not secure. Okay, 2 risks you will face with what? Because just now they already told you they are facing those risks like interest rate risk, inflationary risk. What is interest rate risk? Interest rate risk, any change for interest, you may impact your price, right? So especially interest rate is rising, price will be dropped. So basically interest rate risk can be offset max and bond portfolio investment return. So there is interest will be rise, bond price will be fall, and vice versa. If interest rate drop, bond price will be go up. So they are bondholder, they should consider monitor interest rate change. Because any changes for interest rate, it will impact your bond price. So interest rate risk is measured by fixed income security duration with long-term bond having greater price sensitivity to rate change. They are also facing inflation risk as well. So inflation, of course, it will impact your purchase power. So the inflationary risk is based on fixed income interest rate. So any changes, any increase for inflation, they will diminishing your purchase power. So inflation can minimize your real value of bond face value if they want to go for long term for investment. So bond price are quite sensitivity for change inflation forecast. So this is the two major risks they were facing. And strategic passive bond and ladder strategic. So I think in theory, passive bond is what you buy whole, you can involve. They can use passive management strategy maximize their income, generate property or bond. They can hold until mature. Bonds are safe, predictable source income for the long-term investment. The cash flow can contribute immediately after their income. The bond can original purchase for premium or discount, while assume the full par will be received upon maturity. A ladder strategy, you need to come on this portfolio bond with this strengthens maturity date. So I think this one, that ladder strategy is based on different bond types matured in different year, and this ladder strategy is suitable for them because they can manage interest rate risk while maintain steady income stream. So they can, based on future cash need, maintain their liquidity in their portfolio investment. Hey, your answer should be this kind of quality, English level. Some I read your English also. If I say English level not make me feel like I like to read, your mark will be affected. Your English level, the way you discuss the question. I expect you can write more, but of course must relevant. Don't give me some answer which is not relevant. Okay, this one is another question 2. Where is the question 2? Question 2 asks you this thing. They give you this pessimistic, consensus, optimistic, all this figure. Calculate your expected goal rate based on 3 scenarios. 3 scenarios is pessimistic, consensus is optimistic. Calculate PE, calculate intrinsic value, assuming the market index is 2030, estimate rate of return. So this one you base on like this. Goal rate, very simple. What's the goal rate? 1 minus the dividend paid, 0.45 is the dividend payout, right? 1 minus 0.45, 45 is the dividend payout times your 0.15 is your what? Okay, 0.15, 0.825. Okay, 0.15 is the ROE. 151311 is ROE. So your goal rate is 0.825, 0.585, 0.385. So this one is the way for you to calculate your goal rate. Your required return. How do you get your required return? 0.08 is come from where? So because 0.151311 is the ROE. Okay, 345, this one is what? They ask you calculate your required return, right? 0.11. Okay. I leave the required return first. Go to PE. PE is what? 0.45, 0.55, 0.65 is based on the PE ratio. D over K minus G, right? Dividend is where? 0.45, 0.55, 0.65, right? K, you know, right? K is a required return. So I give you 0.08 plus 0.03. That one is your risk premium. 0.03, 0.08 is what? So why I should put the risk premium 0.03, 0.04? So overall, I get the required return. Okay, please spend some time to go through the thing. Risk-free rate, right? I think this required return, you add up You base on risk-free rate plus risk premium. You follow? How do I get this required return? I use this risk premium plus risk-free rate. Okay, I better write. Follow, not follow. How do I get the required return? 0.08 plus 0.03, 0.09 plus 0.04, risk-free plus risk premium. Okay, follow? Then I get my required return. Risk-free plus risk premium. Okay, once I get required return, then I get my K, right? K is 0.11 minus my D, 0.45, right? D is the dividend. Minus my growth rate. D over K minus G, remember? Hello. How do I get D? D is the 0.45 dividend. K is from here. Dividend is growth rate here. Get your PE. Once you get your PE, calculate your intrinsic market value. So you get your PE ratio times the 66.3. So you get your price given 66.3, 53.84. Earning per share. Earning per share times your PE, you get all the price for your intrinsic market value. Then expected rate of return minus 1 because my index market is 2030. So overall you can see your estimate rate of return. Optimistic you get 46.55 for negative. Consensus is negative 79. Pessimistic is negative 88. So you can see optimistic even though make losses, but the negative return is lower. But pessimistic, your negative return is the highest. Consensus is between that. So you have to show the step by step in detail. How do you get all the figure? Okay. Next one, the index portfolio strategy and passive. So the question asks you index portfolio and passive. Even though 4 mark, I expect you write more than 4 lines. Of course, it doesn't mean you should write very long, but relevant. Index portfolio stands for what? It's a trick technique using index fund to build portfolio. This is passive investment. They help investor build your wealth, less expand. Index fund can be mutual fund, ETF fund. They are built by financial firm to mimic a specific financial index. So you have hold the share of stock from company in particular index. As a portfolio manager, you have to build your portfolio match the performance index, reduce cost of R&D. As a manager, you have to based on close the portfolio trade the index or trading area rather than risk return performance evaluation. So that is index portfolio strategy. Passive is what? Maximize return, minimize buy and sell, prefer buy and hold for long term. Minimize your trade in market. Passive investing, you should look at how to avoid the fees, limited performance, and incur when frequent trade. The goal is build well gradually. And then this buy and hold mean purchase security to long term. And less expand, less complex, and then maybe go for long term horizon. Expect active managed portfolio. Can answer? Very English must be power, Can do it. This one, bond immunization. What is bond immunization objective? My question here. So discuss objective bond immunization. So we want to look at the rebalance. So portfolio managers consider immunized strategy for client. So as a manager, you must consider portfolio must be rebalanced frequently, match the duration. The bond investment, the duration must match with investment horizon. So that is called zero coupon bond. The objective is what? You want to get your duration investment horizon matching. Because any duration and investment horizon not matching, the change for interest rate will affect your return. So the objective, this is the objective for bond immunization strategy. So you have to say this bond investment Bond immunization strategy is to lock return in respect how interest rate change over investment horizon. So bond immunization strategy immunize, protect portfolio against interest rate risk. It's involved two types of risk, price risk and reinvestment risk. Still remember? Price risk and reinvestment risk in your IFA you learn. Move in opposite direction. When you immunize your portfolio, it will maintain duration portfolio, equal investment horizon. Duration is the basic for immunized theory. Portfolio immunized if this duration make equal to pre-select investment horizon for portfolio. And bond investment, I'm going to test you duration. Duration, what is the impact? What is the factor affect the duration? You know or not? Anyone know about the factor affect the duration of all this? Later I'll show you one. In your IFA you studied before, right? Forgot already, I think. You forgot, Convexity is what? Convexity refer to the shape of the price yield. Anyone still remember convexity? How does the curve look like? Can remember, don't remember? This one convexity. This one later lah. You know, you go to my Google Classroom. Okay, the convexity, what actually the meaning? Okay, measure the rate of change modified the duration as yield change. Convexity refers to the shape of the price yield relation. It's a curve, right? Instead of a straight line. So you have to look at any change for the interest rate. Okay, the rate of change modified duration is yield change. So it's a shape of price yield relation can be used to refine modified duration approximation of sensitive price and interest rate change. So they will show you the price rise at the greater rate as you thought. Okay, they thought or whatever. So you have to look at the duration price and in fact convexity of price should be add together to obtain improved approximate change in price given change in the yield. So this is all theory, convexity. And these are current yield calculation. Annual interest income divide current market price of the bond. So the question give you here is, they give you this particular bond with 4 types of bond. So based on investment, 200K in his inheritance in follow 4 coupon bond. So this one is all the coupon bond can be seen. The first one is which one is zero bond? The bond number 2 is zero bond. Bond 1, 3, 4, all these are coupon bond. So they give you the price, give you duration, give you yield maturity. So you have to compute your current yield modified duration. If interest rate drop by, this one not drop, this is rise. Can be sometimes the question give you interest rate reduce, interest rate rising by how many point, the weighted average duration. This kind of question you must really know how to compute current yield, modified duration, weighted average, and how do you see this immunized portfolio. Okay, example, the first one, bond 1 is 12 year mature, 7.5. Do you print out your question or not? Please do some past year question, do some print out lah. In fact, I don't want you spoon feed like this, I want you to do now. Don't give you answer. Can you try to calculate some now? I give you 5 minutes. How to do? Current yield is what? Equal annual interest income over current market.